Hey trade pros, welcome to lesson 3 of order flow basics. This is Sarah from TRADEPRO Academy, and this is the final lesson of our order flow course that's offered exclusively on YouTube. And today we're going to be talking about day trading with order flow and charts. But before we get started, let's play that intro. So on today's agenda, we're going to be talking about combining order flow and charts, repeat calls and puts and market sentiment, levels and spot price, order time, and contract price. If you haven't already, guys, hit that like and subscribe button. So being able to read both charts and order flow helps us paint the full picture. Combining charts with order flow can help us identify the following: which levels buyers and sellers step in, confirmation of puts or calls or shares were bought or sold, ticker and market sentiment, and the future price of a stock. So using flow as a sentiment indicator. When we see repeat calls or puts in a ticker or ETF, that is usually a clear indication of market direction. So in order to discern whether or not calls and puts were bought or sold, we can combine technical analysis with flow analysis. So both technical analysis and flow analysis assist us in determining market sentiment in an underlying. So here we're seeing repeat puts in Tesla. If we combine the Tesla put sweeps with technical analysis, we can determine that these puts were likely bought and not sold for a premium. As we can see on the 1-hour chart, Tesla is currently making a new low. If we take a look at the spot price and time, these puts were bought as Tesla was falling, indicating more downside and a potential break of support. So by painting a full picture with the information available, we are bearish on Tesla. So as discussed in lesson 1, using the spot price is a great way to determine at what price and levels buyers and sellers step in, as well as overall sentiment. So here we have some order flow from July 13th, 2021. As you can see, it's all calls on Apple. As seen on the previous slide, we are seeing the repeat Apple calls come in through the tape. And if you pay close attention to the spot price continued to move up with Apple calls coming in. So if we go back, we can continuously see the spot price move up, which is under reference, and then we can see the strike price as well. So as Apple continued to move, the calls kept coming in and the spot price kept moving up, indicating more upside. So what happened next? Apple gapped up overnight, hitting a high of 149.50 the next day. So by hitting 149.50, all calls that were bought at the tops yesterday turned green. The highest spot price from the previous day was 147.22, meaning we have demand up until that level. Because there was no buying above 147.22, in theory, we can assume that we have supply above that level. This level is also where short-term resistance was formed. However, combining sentiment analysis with spot price analysis, along with strike price analysis, so we had repeat in the money calls and at the money calls coming in, indicating a higher delta and or gamma level. There was likely more upside in Apple. Therefore, it's beneficial to assume that these calls were swung. So as mentioned on the previous slide, all of these calls were very green the next day as Apple broke through short-term resistance and yesterday's supply became a demand zone. Taking a second look at this Apple call activity, we should also pay attention to the time the orders were executed. As we are seeing, Apple calls were consistently coming in throughout the morning session. So we're seeing calls start to come in at 9:45 a.m. all the way up until 11:22 a.m. So in addition to seeing at what spot price buyers stepped in, we also need to pay close attention to the time the options orders were executed. So because we didn't see repeat call activity come in after 11:22 a.m., in theory, even though Apple did end up gapping up, we should not buy again unless we can get at in at the same spot price and contract price as the previous flow. So with that being said, Apple did hit the spot price of the call activity that came in at 11:21 a.m. So as we can see, as the day went on, Apple went back to the spot price from 11:21. So therefore, this offers a good risk reward ratio by getting in at the same spot price and contract price for a swing. So contract price. Contract price is also very important when following order flow. So in theory, we want to always attain the same contract price or a lower contract price than the flow we are following. So contract price is determined off of a variety of factors, including the price of the underlying, implied volatility, and liquidity. So contract price, along with the spot price and time the order is executed, is important because we have to make the assumption that it is possible that the institutional buyer is taking profit when the contract is green. So although the date of expiry gives us some insight into when they may take profit, sometimes they will buy long-dated contracts for short-term trades because of slow market conditions and theta. They do not want theta to be a factor if they're going long. So combining technical analysis, once again, with order flow can help us determine if the flow is a day trade or a longer-term hold. So taking another look at the Tesla puts from earlier, and in particular, the 530 puts, these have an expiry of July 23rd, 2021. And we do not want to follow this flow if we cannot get a fill at $1.80 a contract or less. It's also pretty easy to determine that unless Tesla plunges to new extreme lows next week, this is a day trade, anticipating Tesla to either test or lose 660 support. The week out expiry gave this buyer cheap puts, and because it was a short-term hold, theta wouldn't be a factor. So because they have an extra week, they could afford to go that much out of the money. So they do not expect Tesla to hit 530. They just expect Tesla to lose support this week. So here's an example. As we saw on slide 5, Tesla was soon below the 666 level spot price, and these puts would have went green rather quickly. It's likely that the put purchaser cashed in at the 660 support before theta became a factor. By paying special attention to the bearish inverted hammer candle on the 1-hour chart, which happened to take place at the spot price where these puts were bought, it was a good assumption that the next candle would be bearish, which it was, as we can see, broke through support. If we did not get in at this level for the same price or better, we would not have gathered that much of a return, or we could have even taken a loss. After testing and ultimately losing 660 support, buyers stepped in, taking Tesla back above 660. So theta would have also become a factor if we held for that long, and our contract price would have begun to lose value. So in this case, if we were late, we should ignore this flow. Although these contracts would be even less now because of theta decay and in theory a better price, because they are so out of the money and the chart is indicating a further bounce, we would not follow this flow. So that's the end of lesson 3, guys. I hope you found it helpful. If you haven't already, hit that like and subscribe button once again. Follow TradePro Flow on Twitter for real-time order flow alerts. And trade live with us at community.tradeproacademy.com. Love doing this series for YouTube, guys. It's been a pleasure. Looking forward to doing more in the future, and see you all in our community. Take care.